Welcome back to this NASDAQ video on the 1 hour time frame. We're going to be going through ICT and order flow, how you can combine both of them to get your desired outcome in the markets, right? So if we start with an ICT masterclass, right, it's essentially looking at the dealing range, understanding your market structure. So how am I looking at market structure on NASDAQ here on the 1 hour time frame? So what I'm seeing is I'm seeing a structural high, I'm seeing a structural low, and then I'm seeing a break of structure over here. So I am going to mark this as my structural high over here. This to me is all internal structure, internal range liquidity over here. And so why am I showing you this? So when I look at the markets, I'm typically looking for a 4-step process when it comes to my higher time frame bias. So a higher time frame bias, for those of you who don't know, so a higher time frame bias is going to be made up of 4 unique elements. We want to see market structure. We want to look at what our dealing range is. We then want to understand where the premium and discount arrays are. And then last but not least, we want to understand where your fair value gaps are. And we also pair this with a fifth idea is liquidity. So we're looking at these 4 things every single time we take a trade. Okay. So if we go back here to NASDAQ on the 1 hour time frame, what we can see over here is we see a very clear break of the market structure. And so this break here is bullish, of course, and now we are basically looking at fair value gaps, right? So what we can see here is we can see price leaving a fair value gap just over here. So this is in the discount, right? So we have a discounted fair value gap resting over here, and we can see price hasn't really necessarily broken outside of the dealing range, although it has now. So we're going to use this information to frame an FOMC trade you could have taken on Wednesday, the 18th of June. And so when we look at this on the 1 hour time frame, we can spot a couple of things. If we just take a look at what we call the weekly cycle. And so this is the weekly cycle. So if we just go back to Monday, right, what are we looking for Monday pre-market open, right? So what I like to do typically is I like to look at Friday's liquidity. And so Friday's liquidity is important to understand, right? So this is what we call previous day high liquidity, right? A lot of people understand this as the PDH or previous day high. So I'm always keeping an eye on previous day high liquidity. So this is something I want all traders to understand, that price will often give you the best bearish weeks, or price will give you the best bearish setups after we've taken out the previous day high. And so this is what I'm looking for pre-market, right? So we can see we eventually do have a sweep of the previous day high. And we also have a sweep of the previous week high as well, which is quite interesting, right? Thursday's high was also swept over here. So we have previous day high liquidity being swept, right? This is the first thing you want to see when you're framing yourself for a bearish setup. Now, the second thing you want to understand is where you are in terms of the dealing range. And so what I mean by that is simply, are you in premium or are you in discount? So this is our 50% area. We are above the 50% area. So we are in a premium, right? We're above the 50% area. This here validates the fact that we can be looking for sells, okay? So if we continue to play price on, we had Monday's price action over here, which gave us no trade really, right? So if we go down to the 15-minute time frame, right, we have, of course, if I get the Asian range out, we see Monday's price action, in my opinion, not giving us the A+ trades we want to see, right? So what we're going to do is we're now going to break down an FOMC trade from Wednesday. So just a quick overview of this, right? When you're trading high impact news events, right, the best way to kind of go about them is to understand the best moves will come often during the events or quite often after the events, right? So let me give you an example of price action you want to avoid, right? So this here was New York session. All of this over here was New York session. So this was around 10:15, and this ended at around 12:30 p.m. Eastern, right? So this is price action you want to avoid, right? It's one day before FOMC. It's not the best place to trade, right? So often the best traders know when not to trade and to preserve their capital, but also their mental capital in and around market conditions, especially when there's high probability news events. So let's just quickly go back to the 1 hour time frame, our higher time frame, right? So from here, what we've seen is the following, right? So we've seen price, we're still now in the premium because we're above this 50%, and price has left a fair value gap over here. And this is what I want traders to kind of understand, right? If we break this down. So if we take a look at FOMC, right, this was the FOMC movement down. How could you have caught this FOMC movement using a trend exhaustion, right? Because this is the series of the videos, right? Trend exhaustion with ICT concepts, right? So this is where we're going to be analyzing price action using the fair value gap concept. So this is a fair value gap you can see over here. Now this is actually the POI. right? So how do I differentiate my POIs from my fair value gaps? This here is the fair value gap, right? So you can see a fair value gap resting just below the POI because the POI is over here. So why am I using this candle as my POI? So very simply put, it's the candle before the fair value gap. That is the point of interest. That is the area of supply in this region. So when we go down now to the 15-minute time frame, we're looking for a potential, well, we had multiple rejections, even on the 5-minute time frame. So on the 5-minute time frame, we had multiple rejections here. We also had our FOMC rejection here, and there was also a lower time frame entry over here before the final move down. So quite erratic price action, I think. But what we're going to be focusing on is why the trend exhausted at this POI. So why did the trend exhaust itself over here? So let's kind of break this down, right? So when price taps into a POI, all right, let's break this down. So when price taps into a POI, what we're looking for is we're looking to combine our entry with a power of 3. So what do I mean by that? So that basically means if we go to the PO3 and we change it to 4 hours, so we are looking to basically sell when price is above the 4-hour candle's opening price. So this is 10 a.m. Eastern, and now we're inside of a POI. So we can see we're way above the 10 a.m. Eastern. This is where a bullish trend is more likely to reverse, right? This is where a bullish trend is more likely to reverse. So we're looking for what we call buyer exhaustion in this region. So if we just kind of play price on a little bit, we can see price heading to the downside. So it's from this region that I would go to the ATAS platform and look at order flow, and that's something we're going to break down. So here we go to ATAS and we read the order flow. So to give people a quick introduction as to what ATAS is, right? ATAS stands for Advanced Trading Analytical Software, and it tells you essentially the bid and the ask, so the buyers and the sellers at key levels. So you want to be reading the order flow inside of fair value gaps. You want to be reading the order flow and seeing who is in control between buyers and sellers, right? So in this case, what we saw is we saw a buyer exhaustion. So a buyer exhaustion, simply put, is like this, right? We see aggressive, I'm just going to write AGG. We see aggressive buyers with no reward, right? They do not break above the level. So when you see aggressive buyers with no reward, what that's telling us is that the buyers are failing to break above the level. And that means there's passive sellers that are present, right? They're passive sellers that are present. They're popping up and they're driving price down. Okay, and we're going to go to the ATAS platform and see how you can do this as well later on in the video. So what we're seeing now, for those who have a sharper eye, is this, right? We see a 5-minute fair value gap inside of inside of a 1-hour fair value gap. It's the same concept, right? So this is the POI and this is essentially the fair value gap. And so if I were to take an entry on this, right, I would want to be shorting at the level with a stop loss just you can either have it here or you can have your stop loss over here, right? It just depends. So you are looking for an absorption of buyers, right? So you're using the ATAS platform even here as well. You're looking for the absorption of buyers. And simply put, you want to be targeting the 10 a.m. Eastern as your first target, but realistically, you want to be targeting the fair value gap below the 10 a.m. Eastern, which is really down here. So that's a 1 to 2, 3, 4, depending on how you kind of place your stop loss. So we can see price eventually going and hitting our TP. So that's probably the best trade you could have taken pre-FOMC, right? Pre-FOMC. This happened before FOMC, right? So if we kind of take this over to the side now, let's take a look at the actual FOMC trade you could have taken. So it's a similar concept in the sense that we had this, right? So we had this was FOMC. Quick word of advice, you don't want to be trading at the exact time of FOMC. I prefer to let the market show its hand. And so when you have news events like this, you are using the ATAS platform, you're using the ATAS platform very heavily to detect what is going on inside of this rejection. So this rejection itself is the same as this rejection over here. We saw aggressive buyers failing to break above the level. Notice how we've tapped into this fair value gap. So this is a true area of resistance, and we're going to confirm that right now, right? We're going to confirm that right now. So again, how do you form a trade post FOMC, right? So this was the FOMC news event over here, right? This was the FOMC rejection, and now we have a fair value gap of 1-minute FVG over here, right? Let me just change that to a different color. This is the 1-minute fair value gap. Now, so what makes a 1-minute fair value gap high probability, right? Why is this fair value gap high probability? Well, there's a few reasons for it. First of all, we have seen an overall rejection we've seen an overall rejection of buyers, right? So what that means is that buyers themselves have failed once, twice, and 3 times. So we're trading in an area of strong supply or strong resistance so far, right? The second thing is when you combine it with the fact that we do have a 1 hour POI that's been obviously rejected by buyers, and we're above the 2 p.m. Eastern with this fair value gap over here. So this is a fair value gap that's tapped into a higher time frame fair value gap. We've seen a rejection of buyers, and we're above the 2 p.m. Eastern. So this is what gives us confirmation to take the short position from over here. So if we just play price on, the way that I would personally want to look at this is I want to see what's going on inside of this area, right? So again, that's where the HTF platform becomes quite useful. So if we just go back to the 5-minute chart over here, what I would want to do if I was trading this personally is I would want to trade above the 2 p.m. Eastern with my stop loss above the last local rejection just over here. And now from here, where would you look to target? Well, good question. So first of all, targets always come down to liquidity. So we have trendline liquidity resting over here, but we also have the Asian low intact, right? The Asian low hasn't been swept, right? So we have the Asian low that's been intact. So your target for both trades would actually be down here, just like this, right? So if we continue now to play price on, we are going to be going over the HTF platform. We're going to be studying what was going on inside of the region, right? But as you can see, price does hit our overall target eventually. Well, it almost does, right? But I think price, hovered for a bit, but we ended up getting there in the end, right? So when we take these trades like this, right? When we take these trades, we want to ask ourselves a couple of things, right? How can you determine a trend is going to end, right? What gives you the indication? So a trend could end here, a trend could end here, the trend ended here. So notice how we're above the 2 p.m. and the 10 a.m. candles opening price for all of these trades, right? So in this region, we now go down to the ATAS or the Advanced Trading Analytical Software. Right, so we have the HTF platform, my favorite platform to trade, and this was the FOMC meltdown. You can see all the way down here. So why did NQ or the Nasdaq melt down during this particular fair value gap? And so to give you some context, right, this price action you saw melting down was the same as this PM session trade over here, right? So this PM session trade, we're going to be breaking down what is happening inside of this boxed region, right? So what was going on in this region, right? This is important to understand. So I'm going to label this in dark blue and you're going to see why, right? What was going on over here? So this is where we use our trusted HTF platform to our advantage. So this FOMC meltdown, if we just take a look at the FOMC rejection, so this wick over here, right? I want traders to understand how a wick forms, why a wick forms, and what is typically going on inside of a wick, right? It's very interesting when you go inside of the wick and you can kind of understand the story, right? So what we can see, even without looking at the numbers like I often do, we can see a red candle, right? This is obviously a red candle. Now, if you look closer to the top, can you see how there's blue over here, which is why I've shaded this region in blue? Can you see the blue kind of, rectangles, horizontal rectangles over here, right? When you see blue inside of any candle, be it red candle, green candle, that is showing you that there's a more aggressive buyers than sellers, right? That's showing you the ask, which is the aggressive buyers are greater than the bid. That is the first thing to understand. The second thing you want to look at is you want to ask yourself, well, where is the volume in this candle situated? Where is the volume, right? So volume is just a fancy way of saying, where is the interest in the market, right? Where are there the most number of transactions in this candle? So this here, we can see the majority of the volume is situated in the lower half of the candle. So that means as the market moved higher in this region, we can see the market moving higher, and then we can see the market moving higher. When you see the market moving higher and the volume decreases, that means there's a lack of interest for higher prices, and that is how I use volume to my advantage. That is how you use volume to determine an overall trend exhaustion. If you see the market moving higher, right, trending higher, and you see the volume decreasing alongside the direction of the trend, this basically tells us, right? This significantly tells us a reduction in volume, and it shows us that the market is is not interested in higher prices, right? Simply put, a lower volume means lower interest. So you know the markets are going to reverse at some point. Now, we obviously time this with fair value gaps, etc., you know, 2 p.m. candles opening. But we can see FOMC rejecting pretty aggressively this POI. Now, if we head back here, we can see the final rejection from this area before the market melted lower. And so we are going to understand this, right? We are going to understand what was going on up here, right? So if we kind of break this down for traders, so what we can see is we see a lot of blue delta and we see a huge red delta stepping in, right? This is aggressive buyers failing, right? This is aggressive buyers that are failing. Even over here, this green candle before the meltdown over here, this green candle actually had a significant number of aggressive buyers at the top, right? And so I had a question about this recently. We can see zero prints at the top, right? So we see 0, 0, 0, 0, 0. We see a lot of zeros at the top, which represents this region, right? So what that's showing you is that the market is moving higher, but the volume itself is decreasing. And so when the volume decreases, this shows us a lack of interest for higher prices. And this indicates the markets are likely to reverse and therefore the bullish trend is exhausted, right? That's basically how trend exhaustions work. We pair them with fair value gaps. What's even more interesting is that we can see the aggressive buyers switch to aggressive sellers inside of a 5-minute green candle. And so inside of a 5-minute green candle, we see 124 for 27. So we're seeing the sellers, the aggressive sellers, step into the market after the aggressive buyers have failed to drive the market higher. So this shows us a lack of volume to the upside, as well as a lack of reward, a lack of success for the buyers. And so that means that the sellers are in control, the volume is supporting lower prices. And that is the reason the market tanked, right? That is the reason the market tanked. So I'm using the A-test platform with my analysis to predict lower prices, right? Sell trades. And so this is something I teach at Price Action Labs. I've got obviously a course, mentorship, etc. If you are interested in booking in with that, feel free to comment below and I'll be more than happy to give you the details on that. But until then, take care.